price chart, I think, is the best guide of what the asset is doing, what its trend is, how people are perceiving it, and where it is versus what you might perceive as fair value. You notice certain characteristics, like crypto tends to be exponential in price. So you put it on a logarithmic chart, it starts to make sense. You look at things like copper and lumber, they tend to be mean reverting assets because they get met by excess supply. With high prices lead to excess supply. So right now with oil at $100, everybody wants to make as much oil as possible. So the price comes down over time. It doesn't happen with crypto because you can't.
Right.
So you need to understand the structure of markets, where the sentiment is. Is it overly bearish? Like a day like today, it got overly bearish. And so suddenly you start to see a reversal. So these kind of things are interesting. But my big discovery and why I really started loading up on Ethereum was another chart, which was a understanding that Metcalfes Law was the primary driver of all crypto markets. And in fact, almost all of the tech stocks that we've known today.
Right.
And once you realize that these are basically networks, and once you realize that crypto are networks where you actually own the network. So Facebook is a great network stock and it works perfectly on a log chart and it's an exponential, does all the things as you imagine. You can value it in Metcalfes Law terms, but the fundamental difference is shareholders and network users are not aligned. The shareholders make the money, the network users get the utility. Along comes crypto, you marry the network user with the owner. Okay, now you've got network effects upon network effects. This is like behavioral economics. It's religion meets capitalism. It's basically what it is, right? So that is incredibly powerful. So I start looking at the fact that Bitcoin and Ethereum charts just at different points at the same point in the adoption cycle were remarkably similar. And then it dawned on me is they're all the bloody same thing. They're all about adoption. So if you look at it and if you're honest with yourself, Ethereum, if you think about Metcalfes Law, it's about the number of users and then the kind of connections between the users and the applications built to create those connections. Well, Bitcoin's kind of a one-sided one, which is a bunch of people own it as a store of value, like gold. Nothing wrong with that, but there's not many applications built on it. When you look at Ethereum, it's like, holy shit. I mean, this is like the internet.
Right.
That moment is like, okay, this is far superior a bet. And so that's why I took that bet. And then I eventually shifted majority into Ethereum and then took other bets in the space to express macro views. I had lived through the financial crisis and predicted it. I had also lived through the European crisis and predicted it, and had been in Europe and had to buy a generator and food and get cash out of the bank and keep it at home, right? That's how close we were in Spain to losing our entire banking system. And as a macro guy, I knew the issue was leverage. And leverage had meant that we had a unique problem, which was a layer of collateral, and all of this debt is against the collateral. And usually you've got like 30 claims on the same piece of collateral. In fact, the average US Treasury has 32 claims on it, or it did then, may have more now. So therefore, who owns what in an unraveling? Who's going to get screwed?
The leverage was, you're talking about government or corporate, or where did you see this stockpile of leverage?
I look at total leverage, financial system leverage, government leverage, household leverage, and private sector leverage. Right, so we're at 480% of GDP now, whatever the stupid number is, right? It's ridiculous. Right. But the problem is that's a lot of claims on the collateral. So, because not everything is collateral in the system, only some things are used as collateral. Anyway, so when Lehman went bust, right, everyone's scrambling to find who owns what, and that happens all the time. So I started trying to start the world's safest bank with a bunch of family offices. I thought, we could say a bank that doesn't use leverage, so then people can put assets there, their savings there, and realize they're safe, because it wasn't safe. People in Cyprus had all of their money taken out by the government. Right. So I'm like, okay, I need to do something about this, and I can do something about it. So I started that journey, and a friend of mine called Emil Woods, who was a subscriber to Global Macro Investor, who was running a hedge fund at the time, an ex-Goldman guy, he said, you need to look at Bitcoin. And I'd read a bit about Bitcoin. It's probably 2012. Wrote the first macro piece on Bitcoin, which is, I think, the thing you referred to, which is 2013. I was just like, I saw it and thought, okay, so we've got two things here. One is this asset, Bitcoin, and that's a scarce asset in a digital world, so that's probably interesting. And secondly, we've got blockchain, which is a recorded ownership of everything. okay, well, that solves the entire financial system, and this could be something useful for the financial system in itself as a new version of gold.